Good evening, everybody. Welcome to the Crowdlords PEVAM webinar on commercial property. There's a couple of people still arriving, but as they arrive, we'll add them to the meeting. But because it's 7 o'clock in the evening, we'll carry on and not wait too long. Thanks very much for attending. We very much appreciate it, and thanks very much to our guests, Richard and Doug from PEVAM. This webinar is all about commercial property. And we're delighted that we have a trial property on the website and due to go launch with it very shortly. And that's been brought to us by Richard and Doug, who have more years than they would like to admit in the industry, and great expertise. And as Crowdlords, we were always a bit hesitant about commercial property. It was limited. But then when we met Richard and Doug, who's set up this new entity to make commercial investments available to the crowd, we were delighted that they chose our platform to launch this investment. So the idea really is for them to introduce themselves, to talk about why they see commercial property as being a good investment, and then to outline the investment that they're bringing to Crowdlords very shortly. So I'm going to hand over to Richard and Doug. Before I do, if you have any questions, please just write them into your chat box and we'll cover them all at the end once the presentation has finished. Okay, so I'm going to hand over to Doug, who's going to do the presentation.
Great, thank you very much, Richard. Great, well, thank you very much, everybody, and joining us on our first webinar with Crowdlords. We have participants from all over the world. We've got some people from Hong Kong, and we've had a lot of interest from the UAE, and I know we have a strong contingency down in South Africa who've also logged in, so hi. And working with Crowdlords actually has a real benefit in that they're an independent third party who are regulated by the Financial Conduct Authority here in the UK. They're there to represent all the shareholders who come into the crowdfunding structure with us, and also it allows PEVAM to focus on the assets and doing the business. So
just on that point, I think it's important to mention that the investors who invest through crowdfunding are actual shareholders in the property at the end of the day, and will have share certificates, and we represent a 50% of the equity.
Absolutely right, and they will be represented by Crowdlords, who will literally interface with us on a day-to-day basis. But of course, there will be regular updates as to how we're proceeding with the business plan and what's going on. So, looking at commercial real estate, I mean, Rich and I had a look around at what's available on crowdfunding platforms in the UK at the moment, and we felt that commercial real estate was underrepresented, and that there needed to be a simple way of selecting assets that would make sense for a crowdfunding environment, and would allow us to present these in a simple and straightforward way. So, I mean, essentially what we're trying to do here is work through an institutional approach to real estate, but presented in a very simple, straightforward way, and select assets that we believe best suit the retail investor in terms of security and income. So before we get into the assets, just a quick snapshot at how things look on the UK High Street. In broad terms, the headlines for the UK High Street have been dominated by the encroachment of the internet and the impact that has had on retailers. And we've literally had a perfect storm with the recent financial crisis, encroachment from internet retail. And this has really set the high street back in the UK over the last few years. And essentially what we're seeing now is a recovery. And we view the UK High Street as offering a particular value when you compare it to historic pricing.
I think it's worth also here just pointing out that the high street obviously is a term used over a vast area of city centres, and the locations that we are focusing on for PEVAM are what would be prime locations in the high street. So the high street is divided into what's known as prime, secondary and tertiary. The types of retailers in the prime high street are very well established, usually very large, successful companies, and this is the sector that we are concentrating on crowdfunding.
I think certainly where there's been some pain and difficulty, there's also a huge opportunity for the smart, the nimble and the quick, and we're seeing this from retailers. Some retailers are performing extremely well and are adapting incredibly well to the new market environment, and the same is true for investors. Just a comment on residential and buy-to-let investment. London residential pricing currently is 40% ahead of the historic trend. So it's very, very fully priced, and even on an income earning parity basis, it's hard to see where much more growth is going to come out of London, and that is to a lesser extent throughout the rest of the UK, but it certainly is a factor when you're considering an asset allocation. By no means are we saying that you shouldn't be investing in residential property. It's still a very good asset class. I just think that currently, given that retail is recovering, that there's a real pricing opportunity for us to exploit. So moving on then, one of the key things, looking at yield compression, it's been very moderate, but pricing has held up very well in UK retail. And what's also encouraging to see is that it's remained a very liquid asset class, even while the current Brexit spat is going on here in the UK. High street retail is still traded very actively. This is partly because of the lot sizes are smaller.
And the main reason being is you get very high quality investments, smaller lot size than the equivalent in office or logistics sectors, which require to get the same sort of security as these investments, a far greater sum of money.
Which has made it attractive to foreign investors, and there's still a large pool of foreign capital looking for opportunity in the UK, and it's fair to say that that capital now is looking beyond London. London high street retail is pretty fully priced. Obviously, it's very core and highly liquid, and increasingly we'll be looking for opportunities in prime high street locations outside of core central London. That said, looking to the future for the high street, it's fair to say that the way that we, the customer, interact with the high street has changed, and it will continue to change. And high street retailers need to adapt to that. And in addition, I think town centres will need to offer more in terms of the experience of being on the high street, in terms of entertainment and facilities. And that's where the high street really wins out. I think the battle for convenience has been lost to retail parks and to the internet, but people still want to interact with each other, and they still want to be on the high street. And retailers are able to take advantage of that. We see it performing very well. So, moving on, just talking briefly about the business plan in very broad terms. In buying into commercial real estate, you're essentially buying in to an asset that gives you the right to collect income over the life of the investment. And in assessing how we approach our investments, we'll be looking to safeguard that income by investing in prime locations. This will mean that we either get to retain our existing tenants because it's a prime location with high footfall, meaning a high number of potential customers walking past their front door, or in the event that we do have a vacancy, that we actually are able to attract another high quality tenant who wants to take advantage of that high footfall. So that's the first key pillar of our investment strategy.
And one of the significant differences between investing in commercial property over more say accessible residential buy-to-let property is that when a tenant signs a lease, which they have in this instance a period of 5, 10, 15, sometimes 20 years, that is the length that that tenant has to pay the rent. There is no ability for the tenant to simply move out early or stop paying the cost of the property.
The second key thing, and that's talking to Richard's point, is really focusing on the financial strength of the occupier. And this is what we felt was the right asset class to focus on, because as Richard pointed out earlier, in focusing on high street retail, you get small investment lot sizes. So
Right.
we get small lot sizes with household names, so national or even international brands with very strong covenants. And for that it's very attractive, and it really provides a very secure. Then looking at total returns and how we calculate. If you look at the vertical axis, that is value, and the horizontal axis gives you time for the investment. We will be looking to obviously make very careful acquisitions that fit with our business core business principles and our business plan. And there's an old saying in property that you make your money buying, and asset selection is absolutely vital. So once we've identified the right assets to buy, the purchase price will be made up of a combination of bank debt and equity or capital. And that capital would be a combination of PEVAM. Our investments will be side by side Crowd, and we'll be looking on this first investment to invest 50% of the required capital, and we'll be seeking to raise the other 50% from Crowd investors. Looking at each individual asset, we will then set out a business plan for the investment, which will be adapted depending on what the specifics of each lease is and what we think the optimal business plan will be. The reality is we'll be locked in for that time period. We'll talk you through that in a minute. One of the key components, obviously, during the life of it is secure rental income, which is backed by strong covenants over the life, and in this instance, it will be 5 years of rental income till the first opportunity for the tenant to break. So over that lifetime, we will pay down the mortgage.
Not completely.
Not completely, but there will be an element of amortization required over the business plan. In addition, we will be expecting some capital growth, which in our model now, just for simplicity's sake, we've only assumed a yield compression, but in reality, it will be a combination of rental growth and yield compression, which together will add to the capital stack at the end. And so looking then to the end.
It's just on that point, I think it's important to point out why we have forecast a 5-year investment horizon, because the first rent review occurs in 5 years after we complete the purchase. So the ideal time to sell the asset and take our profits is when the rent is increased and we have some yield compression, and there's still a 5-year term for the next buyer to buy the property and continue.
Obviously, these returns are based on evaluation, and we need to actually sell, and that requires a professional approach to packaging this asset and bring it to market and selling. So those returns have to be realized through a sales process, and obviously,
which is actually something Doug and I both had a lot of experience in the last 20 years.
Absolutely. So, moving on now, finally to the asset. We're very pleased to be making our first investment in Durham, which is a beautiful city. It's a cathedral city in the northeast of England. It has a very old university there. Durham itself is a city with a population of 65,000 people within the city, but importantly, it has a catchment of potential shoppers of 220,000. So these are people who would use Durham as a main centre. Durham is very well positioned, we think, for a medium-sized city, in that it's not close to another very large urban centre, which could potentially bleed off a lot of value out of the high street. So Durham in itself is the centre which people would go to. In addition, we really like Durham because it's got a strong student population. It's got a student population of 17,500 students, but that doesn't take into account all the staff, lecturers, and other trade that university brings in. It's also a tourist destination with over 3 million visitors per year because it's a very old cathedral city. And interestingly, Durham has 70% above the UK average for high quality retail. So, it's obviously an affluent small city as well. This is looking up Sadler Street. Behind me would be the Market Square, and looking straight up Sadler Street, the unit that we're looking at is on the left-hand side, just behind the HSBC, and there's my arrow come in. And it's a unit which is let to Greggs. For those of you who are not familiar with Greggs, Greggs is a very strong, traditional high street bakery who operate in the food on the go sector. What you're looking at on the left is something we call a GOAD map, and this for the retail investor is like the Holy Grail or the Bible of when you're assessing a unit. The unit highlighted in red is where the Greggs unit is, and as you can see, it's quite a deep unit that runs back. And that section of Sadler Street is a very prime sector. If you look at what looks like a V, that is the Prince Bishop Shopping Centre, between the two main entrances to Prince Bishop Shopping Centre. And if you look at the brand names that are around it, you've got HSBC, you've got Nationwide Building Society, you've got Boots, Barclays Bank. So this is really in the heart of the city centre. So again, that's sort of spoken to one of the core pillars of our investment strategy, location. So regardless of what happens with the tenant, we believe this location will retain strong tenant and that it will attract new strong tenants. Greggs itself is a very strong brand. They have, I think, over 1,700 units in fact now. They're on an expansion drive at the moment. Greggs have come out of 75 retail units during 2015, so that means they've given back, but they've taken 122 new units. And this is all about identifying retailers who are responding very proactively to the new market. And this is all about understanding the management and their strategy. And Greggs has got a new format. They are repositioning their locations on the high street.
More importantly, they had the opportunity last year to vacate this shop, but if not,
absolutely. So they've made a new commitment to this location. So while they're making strategic changes to their trading across the UK, this unit they've made a new commitment to going forward. So it's clear that this location is within their strategy going forward. And importantly, it's all about backing the management team. And Roger Whiteside is a very successful retail manager. And the stock market has responded very well to their new strategy, and their share price is doing very well. So it's a good story all around. And also, we're very pleased to see that 4 out of the 5 non-executive board members are women at Greggs. So they're obviously a very forward-thinking company. Now, Dun & Bradstreet have rated the financial strength of Greggs as 5A1, which is very small probability of failure, very strong covenant, which we'll be buying into. Those are the two core pillars which we believe this asset satisfies. We are then looking at the specific business plan and the specific detail around this asset. There's a lease currently being negotiated for this unit. We haven't seen the final lease, but we understand that it will be a 10-year lease term. And as Richard mentioned earlier, there's an opportunity for Greggs to surrender the lease at year 5. That means that our whole business strategy has to focus on that lease event. And the good part about managing commercial real estate is that the notice period the tenant is required to give us as landlords is 12 months normally. And that means that we're fully expecting that Greggs will want to retain this prime location. But in the event that they do decide to leave for whatever reason, we'll have 12 months notice in order to start our hunt for a new tenant. And so that lead-in period is going to be very helpful in terms of maintaining our cash flow.
And can be seamless. In fact, it's possible that we will have another tenant lined up if necessary, without suffering any void period and the obvious impact that would have on our income.
Well, this is the thing about prime high street locations. I mean, you do see vacancies come up, and this is normal churn on a prime high street location. Retailers change their format, they change their strategy for whatever reason, but this is normal churn in response to consumer demand and in response to changing market conditions. But as you will have noticed on your prime high street locations, shop units are not vacant for very long. Yeah. So, Plan A, we've obviously chosen this unit because we believe Greggs is well suited and we believe Greggs is trading well in this location. Our plan A is we're assuming that Greggs will not give notice and that they will wish to stay there for a 10-year term. However, we will have to negotiate a rent review with them, which is an open market rent review. And importantly, in commercial real estate, it's upward only. So there's no opportunity for them under this lease to negotiate the rent down.
Unless, of course, they decide to break the lease at year 5 in order to simply try and negotiate a favourable term. However, this is very unlikely.
And we've dealt with those tricks before. I mean, it really comes down to what demand there is, and it's.
Well, actually, even if they did do that, if there's other evidence in the street and neighbouring shops, it's impossible for them to negotiate another.
Yeah. So, assuming that we agree a rent review, or when we agree a rent review, we would then begin preparing the asset for sale, and that would basically the team at PEVAM would secure the rent review, and then we would report to the shareholders about the market conditions and what our prospects are. And really, the exit is a combination of secure the rent review and then review the market conditions, and then the decision will be made as to whether it will maximize our value to exit that business, within the 5-year business plan. The good news is that we have a further 5 years within which to hold with the income there. Now, Plan B, as Richard mentioned, if Greggs give notice, we'll have a lead-in period within which to begin marketing the unit to another national or international retailer. Greggs will also be required to pay for dilapidations, which means that they have an obligation to return the shop unit in the condition in which they received it. And these are pretty onerous, so we will be ensuring that they fulfill these obligations. And we will then be out to negotiate the best rents and the best lease term that we can get in the marketplace, and then undertake a full marketing once we've secured a new lease, and that will be the exit. It's worth just at this point just highlighting a few of the key terms, so not going into too much detail, but just to highlight some of the key commercial terms which you get in the UK, which are a little bit different perhaps to other international markets. First of all, commercial leases are not always, but generally, and we will always be buying leases which follow the norm, and that is for a full repairing and insuring lease, commonly referred to within commercial real estate sector as FRI lease. And this means that the tenant, not the landlord, the tenant has to pay all the costs of repairs and maintenance, including the insurance for the property.
Now, this is obviously important, and the tenant in this case is a FTSE 250 company. So, this is an area that's completely enforceable, and we would enforce.
The other key point is, as I mentioned already, rent reviews are on a 5-year basis. So unlike a lot of other markets which are attached to indexation, which means that fixed rental uplifts happen each year depending on inflation, this is on a 5-year basis, and then it's to open market. So the opportunity now, considering that vacancy rates are falling, that the market's recovering,
and the vacancy rates in the last few years have come from 16% on the high street down to 11%.
Yeah. So this is all things that will begin to drive rent. So the opportunity now in terms of creating value is to buy in at one rent and have the opportunity to have a significant jump in the rent in year 5, which immediately adds a huge amount of value to the asset when we bring it to market.
Just before we get on to the end value, just finishing on this FRI lease, what this very accurately enables us to do is show you and us the worst case scenario for growth on this asset, being returns to us as investors. This is something that on a buy to let we could also predict, but it's somewhat more of a lottery than on this, because really the lease is a significant contract, company is a significant company, and the location is a significant location. And I think when we go on to the next slide, we can start to see what they're talking about.
Just to finish up on that, so we've already mentioned that you hear the long lead-in periods, the notice periods, which are 6 to 12 months, and we have obviously an onerous dilapidations covenant from the retailer.
Let's now go through the actual acquisition and the financing of this, and how we intend to structure the acquisition of this unit. So the agreed price.
Don't wander around because people won't be able to hear you.
The agreed price that we have to buy this shop unit is £1 million, and the rent, which is in the final throes of negotiation with the tenant, is expected to be £79,600 per annum.
We have we've already done an assessment of rent for shop units that are on the market in Durham. We're comfortable with the rent. As part of our due diligence, we will get a lot more detail, and we will also get a full bank valuation, and the value will also give us an assessment of the rent. But we're comfortable with that.
This is one of the beauties of the UK property market, is it is extremely transparent, and there's lots and lots of comparable evidence, not only on this high street, but on every high street.
Yeah.
So it's very good for us to be able to know whether the unit is over-rented, market-rented, or under-rented. And in this instance, we will have a rent that is in line with the rest of the market for this type of shop and this type of location.
And that's very important for us, getting the pricing right. So the reason we're really focused on understanding that we're getting the right rental level is making sure that we're pricing this asset correctly, and we understand how it's going to perform over the next 5 years.
And on the pricing point, that is effectively calculated through the use of what's known as a net internal yield. So as you can see from where we're looking at the screen here, the rental of 79,600 per annum is 7.48% of 1 million. And that's not quite true because it's actually a bit greater. But in the world of commercial property, the purchase price is discounted by the market assumed acquisition cost, which in this case is 6%. So that's, you can see the factor adjustment of 94%. That is why the yield is 7.48 as opposed to the gross internal yield, which is probably about 7.6%, 7%. So it's the true yield after the acquisition costs, and that's how we pay.
So the acquisition costs in this instance will be slightly different because there is some costs associated with the crowdfunding element of this business model, and those are presented below. So essentially you can see stamp duty, which has come down slightly with the stamp duty revision that's recently came out. There's a legal fee, which we will, by the time we go into due diligence, we will have capped. Wherever possible, PEVAM will always seek to cap all our professional fees going into deals. Richard and I have been through many transactions, and we understand that sometimes transactions don't always go the way that we plan, and we are always looking to minimize risk of costs. On the other hand,
and just actually on the upfront costs, for those of you that are calculating the percentages, it doesn't quite add up to what is just over 10% of the purchase price. The reason for that is that some are calculated on the actual purchase price, some are calculated on the bank debt, and some are calculated on the equity that is raised through crowdfunding. But the total acquisition costs broken down there are expected to be in the range of £100,000 in this instance for this property.
Okay, right, moving on then onto the
actually, sorry, just before we move on,
still up there, don't worry.
Still up there. The loan that we are negotiating with a mainstream bank for this property is 50% of the purchase price. We could actually arrange a higher loan, but what we want to ensure is that this is an asset that performs as we expect. We don't have any undue pressure in any way, and there's no what we would call a ring fence acquisition, where there's no liability from any of the shareholders to guarantee the loan.
And this is quite different to other markets. I've done business in many jurisdictions, and standalone financing is something that's quite unique to the UK. Given the strength of the asset and the strength of the tenant, the bank will deal with this asset and the company as a complete entity. So none of the shareholders and the investors will actually be liable for any of the...
What that means, in essence, is if there's an Armageddon situation and the tenant was to go into bankruptcy, there was no rent,
or the market was in free fall,
something happened that really none of us could foresee or predict at this particular moment, and the bank had no option but to foreclose on the property, there is no liability to us or you as shareholders to put any more money in. The money that we invest at the start of the acquisition of this property is the total exposure that we have.
Yeah, and that's very different in some markets.
And that is, so moving on to the chart that we see here, or the table. This is a 5-year forecast for the property cash flow budget, and I'll just take you through how this works. From the top down, the exit cap rate that we've adopted is 6%, and there are reasons we have adopted that, and it is effectively a catch-all because we haven't increased the rent in 5 years. We've taken that as the cap rate, and the current market cap yield for this type of property in this type of location is actually around about 6%.
Currently.
So we are buying this the yield of 7.5%, which is considerably good value for us. And actually, the reason why we're getting it effectively at a discount is that we are buying a larger property off the same owner favourable deal for us, I suppose, and we want to pass this on to ensure we make an impact on the crowdfunding market with something that is a better deal than perhaps other people might be prepared to offer. So the inputs into here show that clearly we have to pay $1 million for the property. We've got $100,000 in acquisition costs, means we have to pay $1.1 million. We're raising 50% of the cost, which is $500,000 from a bank. That will be at an interest rate of 3.61% per annum or better. That's what we've already been offered. And we are assuming a 15-year amortization period.
Just for some people, I know these different terminologies from people in different countries. Essentially, amortization is the rate at which we pay down the principal debt over the life of the loan. So we will take a loan, even if we borrow the money for 5 years, they will calculate the reduction of the principal debt over a 15-year period. So just so everybody understands the terminology.
So what that means in actual figures is if we go down to year one, the rent received is $79,600, and as we've stated before, because of the lease, that rent is actually the rent we receive. There is no deductions from that, so obviously plus VAT. But there is no deductions from that if the ceiling falls in, or the door breaks, or the tap leaks, or...
Well, in actual fact, when we inspect the property, if the property is not in good condition, we can insist that the tenant makes repairs.
We serve notice on them, and we do inspect the property multiple times per year. So that is what we call the gross rent in this instance. We then have a deduction for our asset management fee, which is relatively minor, but this is a relatively simple property to manage as well. There's clearly only one tenant with a full FRI lease. It's in essence ensuring that we send out invoices, collect the rents, and inspect the property and ensure that there's nothing untoward.
So, I mean, when you compare this to the turnover in residential lease properties where you have letting agents fees and you normally have at least a 10 or 12% management fee, we will manage this in-house, and for that there's a 4% charge.
That amounts to £3,184 per annum. That deducted off the gross rent gives us our net operating income of £76,416 per annum, of which we have available then to pay our financing costs. So the interest is £18,050 per annum. We're not taking any mezzanine finance, so that row is necessary. And the amortization of the debt is it changes obviously, and the interest changes, but you can see it flowing through the table here, what it is each year, which gives a total debt service of $43,753 per annum. Now that leaves surplus income of $32,000 per annum. We have deducted corporation tax without the rate of 20%, and in this instance also we have elected to keep a cash reserve in the company, which is 40% of the surplus rent. That is kept in order really to just deal with any issues that may arise over the break in the lease in 5 years' time. It's really not necessary for anything else, but what we don't want to have is a position in 5 years' time where maybe we have a slightly longer than expected void, and we don't want to have to go back to shareholders to make a call for extra equity to pay the debt. So,
just to give you an example of how that might come about, just so people understand how negotiations might go. If we had to lose Greggs, we may have a tenant lined up who could come in immediately, but assuming it's Apple or a huge retailer coming in that's going to add a lot of value, they may say to us, we'll take a 10-year lease or a 15-year lease, which will add a huge amount of value to our asset. But they could very easily, as part of those negotiations, turn around and say, well, we want up to a year's rent-free as part of the negotiations. So we have a great opportunity to create value. It's the right thing to do. It's going to add capital value, but the cash flow is not going to be there in order for us to secure that tenant.
We
So
need
we
to
want to
be
make
in
sure
the-
that the downside is protected, and that we're not having to go back to investors and ask for more money, or even we'll put the extra money in, but it may dilute
Anyway,
other
it's
shareholders.
something that we believe is
prudent.
prudent and the right thing to do. And just to give you an example, if, for example, Apple did come along and take a 15 or 20-year lease, that would change the exit cap rate from maybe 6% to maybe 4%. And that would add super profit to the deal and would give everyone a very healthy return. Just going back to what we've got, so we keep this cash effectively at the bank accounts of the company, and then when we sell it, if it's not needed, it's simply just distributed to the So we have here a surplus cash flow of around about £16,000 per year, which would be paid out pro rata to the shareholders of the company. This here shows what happens in the event, so the heading's gone, but if you look at the last column, the residual value, 1.273 million, that is the sale price that we would receive from the sale of the asset, assuming a 6% yield on the same rent, plus the cash reserves, less the mortgage balance, which is no longer 500,000 because we've been amortising it for 5 years. It's now 361,000. Gives us a net proceeds at the sale of £960,000. That added to the net operating income, etc., from the final year term, which you can see on the bottom two lines. When we say IRR, that is an internal rate of return, which is a calculation which works out the return you've had, internal rate of return you've had per year, effectively, for the time that you've held the asset. So it was unlevered, in other words, no bank finance, would have shown a 9.5% IRR, and this is the low level of leverage, increases our IRR to 12.1%.
It's probably worthwhile just making additional comments on how we present the returns. I'm aware that Crowdlords tend to present a return on equity, which is a very simple: how much do I put in and how much do I get out? The difference with an IRR is that the IRR calculates time value of money. So in essence, it says if you're going to make a 50% profit, a 50% profit over 5 years is better than a 50% profit over 20 years. So you'd rather have, so that it takes into account how long it took to get that profit. So for an investor, it really is a very accurate calculation of how successful your business plan has been. If we offered you the same returns but over 10 years, it would be less exciting than over 5.
Yeah, exactly. The IRR would be 5%, not 10%.
Yeah, exactly.
Just to take you through the equity side of the funding. So this asset, as I said, we raised 500,000 from the bank. We need to put another 601,000 in ourselves. So that's called the equity in the situation, of which we are investing 50% of that, 300,000, and the crowd will invest 300,000. How do PEVAM, what do we get out of this deal? So, how we're rewarded for our efforts, because clearly
2,000 a year is not a great profit.
You know, we would like to make some money, and obviously Crowdlords will make some money, and of course you, the investor, also want to make some money. So what we do is we have minimal upfront fees, as you saw, the 1% fee from property acquisition. We take what's called a promote, which means that the better we are as asset managers, and the better
the asset performance.
The performance of this deal, the more money we make and the more money you make. So we put in a threshold, a minimum threshold of 5% IRR, which means 5% performance per year. In my view, is better than what you'll get in a bank. It's better than what you'll get in a lot of investments, but it's not good enough for us to warrant being rewarded for our efforts. So from 0 to 5% IRR, we make nothing. And then it goes up in multiples. The more IRR the deal makes, the bigger slice of the profits we take, and obviously the more you make.
How these IRR thresholds work for the promote. When you're looking at these percentages, these are like tax bands. So it's the same way that your taxes, so the first 5% is never going to be shared. So you get that no matter what. It's not it's not if we hit a 12% IRR, we're going to take 80% of everything. So you look at these in the same way that tax bands are calculated. So it's on each additional threshold, we will take a bigger slice. So essentially, by the time we get to 80%, we're taking 80% of a relatively small slice at the top of the chart.
So basically, the expected IRR on the very conservative forecast that we have prepared is 9.5% for the investor.
Okay, I think that's the end of it. Have we got any questions? I think we've covered all of the. I think, Richard, it's probably worthwhile from your side just explaining when and how we go live, and maybe some of the people who dialed in will need to understand what the process is for signing up and getting access. I think some of the people we've spoken to would need a little bit of guidance as to why they have to register and what they have to do.
Okay, so if you're new to Crowdlords, we operate under FCI guidelines, as Doug explained. So we're only allowed to show the financial details to people that are self-accredited as either being high net worth or sophisticated investors, which I'm sure you all are. So the first thing that you have to do is to register on our site and self-accredit yourself. But we will then do the anti-money laundering and KYC checks whilst you look at the investment. The investment at the moment is listed as a trial, which means that you can show your interest, but you can't actually invest any money. But once we go live, then you're able to invest directly through the website. And for larger investments, we arrange for those payments to be made later into a bank account. For smaller investments, we do it via an online electronic wallet called Mango Pay. So it's very secure. We don't access the money until the purchase is completed or in time to complete purchase. So that's how it works.
Well, Richard, thank you very much for hosting us today. I think we've covered all the topics, and we look forward to going live with our first investment with Crowdlords.
Okay, thank you. I'd like to say thank you on behalf of Crowdlords to both you, Richard and Doug, and for everybody else who attended. If you missed any of the presentation, we will make it available. So if you want a copy, just email us at support@crowdlords.com. And we will send an email around to everybody as well with a download link so that you can listen to it again and review the slides if you want to, if you're a sucker for punishment. But sincerely, both of you, thank you very much. I always learn something every time I hear both of you speak, and I hope it's been the same for everybody else. So thank you very much for attending. Thank you.
Thank you.